This is All India Radio. In the program Spotlight, we now bring you a discussion on RBI monetary policy and impact on economic growth. The participants are Puneet Jain, economic analyst, and Arya Madan Mohan, journalist.
Before we go into the details, Puneetji, just for some of the listeners who may not be so familiar with economic terms, etc., can we start with a few basics? What is monetary policy, just briefly?
Basically, monetary policy is the policy which is set up by the Central Bank of India, which is basically the Reserve Bank in this case, which controls all money supply. People think that money is controlled, whether supply of money or printing of notes, that is controlled by government. That is not so. How much money has to be given to banks, how much money banks give to the people, at what rate banks lend to people, all these issues are actually governed by the Reserve Bank of India, which has the mandate to keep the inflation under control. So it is not Government of India or the political leadership of the country which decides all these issues. For example, the interest rates or how the loans are given or how the loans are recovered. All that is actually a domain of the Reserve Bank of India. And the objective is to keep this as objective and as beneficial to the country and away from the political consideration. People feel that inflation can go higher, but they will give more money. And that is the reason that RBI or the central bank is given the powers and not the government. That all this policy, all these features basically combine to form the monetary policy.
Puneetji, it's interesting what you say, because I suppose then the government handles the fiscal side in terms of the tax which is levied on people and corporations, and the RBI is responsible for ensuring the other side of the equation, which is given the government's policies on tax and etc. and need to raise money, they then control interest rates and inflation to minimize the inflation rate, correct?
Absolutely. In fact, government handles what is called, like you said, the fiscal policy. Fiscal policy has tax structures in it which impact manufacturing, that is supply and consumption of goods. So government can control the supply and consumption by changing the tax structure, by changing income tax or indirect taxes. And Reserve Bank of India impacts the demand and supply by changing the money supply, which is the monetary policy. And that is how economics are balanced in the best interest of the country.
We're actually in a very interesting state at the moment, which is with COVID, and this is a 1 in 100 year kind of difficult event. How has the RBI positioned itself to deal with this? I guess some key points, and then what we'll do is we'll drill down deeper into the elements.
In this pandemic, the major concern or the major problem that any country would face would be the well-being of the people through economic growth and through availability of sufficient amount of money in the hands of people. In the early stages, when there was a complete shutdown of the economy, the fears were that people who have money in the banks, they will not be able to access that money. Or people who have taken loans, they will be in economic problems because how will they return those loans? So all these problems were there, which are related directly to the money part. So Reserve Bank of India in the early days of the pandemic took some important steps. First, I think they did was to ensure that banks remained open, even in early days of the lockdown. And that was an essential service. They kept supplying money to the people who needed money. Secondly, for small borrowers, for small businesses, they gave many steps, they gave many incentives so that they did not have to repay immediately the loans or the EMIs. So RBI kept on taking steps to ease the burden on borrowers in the early stages. Simultaneously, government also announced many steps. Government announced tax incentives, they extended the date of payment of taxes, they gave relief in TDS. So Reserve Bank and government, they work in tandem, they work together to ensure that people do not face economic hardship. I think they have done very well in the last 6 months. Government has played a very important role. And also we must remember that RBI is guided by the government. RBI, we have something called the Monetary Policy Committee, which has representations from the government through some nominations, and we have some officers of the RBI, and together they form the government. So it is not RBI something doing independently. They do it with the guidance of the government.
That's actually very interesting, because there have been some recent changes in the MPC structure. I think they've appointed another 3 more independent economists to the committee. Now, in terms of the actual policy of the RBI, there is a key need at the moment to stimulate growth, because naturally in the second quarter of the calendar year we saw this massive reduction of 24% in our GDP based on the fact that there was full lockdown. So what has the MPC been doing in terms of inflation targeting? Is that still a policy? How is it working?
Primary objective of the MPC or the Monetary Policy Committee was defined as the goal to keep inflation under control, and that goal has been defined as 4% inflation plus minus 2%, because of course inflation will go up and go down a little bit. So 4% plus plus minus 2% was the goal which was given to MPC, the mandate. However, in recent times, we have seen that Reserve Bank has kind of tweaked this objective. And in fact, yesterday's monetary policy they came out with had very three clear goals that RBI had. First goal was, and it's a very important signal, RBI has said that they value growth more than inflation. So while inflation has been going up a little bit lately, the truth is that RBI clearly said that we want growth first. We don't want to compromise on growth. So they've put growth over inflation in yesterday's policy. Personally, I would say it's a very welcome step and good for the country. Second objective was to keep interest rates low so that people have enough access to credit. If they want to borrow money for consumption, they should be able to borrow without any problem, and sufficient money should be available in the system that people can borrow at low rate. And third and very important objective was they have tried to give certain incentives to the banks, because banks are under the dictate of RBI. So they have built in certain measures to give incentives to the banks to lend more money to consumers, whether for home buyers or for small borrowers, for personal loan takers. So some very important incentives were built into the policy yesterday.
Punitji, actually that's very interesting, because at the same time it's quite clear that the RBI's focus of tolerating a certain amount of inflation to bring about good growth is not just an Indian phenomenon. It's actually mentioned by the Federal Reserve in the USA a few weeks ago, and basically clarifying that yes, we're going to not be worried about inflation in the short term, but we really do need growth to pick up as fast as possible. This seems to be a global phenomenon, correct?
I think economies around the world are worried that pandemic should not affect growth in such a manner that the poor people, see, whenever growth falls, it is not the richest people who suffer the first. It is the poorest people at the margins of the economy or at the margin of society who get hurt the most. So it is the street vendors and the small shopkeepers who get hurt by falling growth. So I think very aptly, central banks across the world have now said that our priority is to ensure that we protect the interests of these small borrowers, poor people, and that growth does not fall off the cliff. And they have enough means on their livelihood. You are right. Earlier, inflation used to be the main concern of central banks, but in these special days, all central banks, particularly the Reserve Bank of India, they have clearly stated that growth is their first objective, and they want growth at reasonable inflation. So they're not overly worried about inflation. They are worried, but they're not overly worried. They're saying we want growth first.
The other aspect of the overall monetary policy has to look at the government borrowing. And what is government borrowing or government finances looking like this year? And I guess in government one has to also include, because of the GST shortfall, also state level borrowing.
Usually when the central government, they come out with the budget, they say that usually expenditure is more than the income of the government, which is what we call fiscal deficit. In this year, when the budget was presented on 1st February, this fiscal deficit was actually 7 lakh crores. And usually government makes up this shortfall by borrowing it from the market. So government issues securities for government securities, and which Reserve Bank of India issues on behalf of government, and government makes up the shortfall. Initially, in February, the goal was to raise 7 lakh crores from the market. That is what government borrowings was. However, because of the fall in tax revenues during the pandemic, now the estimate of the government is that this shortfall will be 12 lakh crores. In fact, 5 lakh crores more will be a shortfall in our revenues, which has to be then made up from the market. So government borrowings in the current year have gone up from a target of 7 lakh crores to 12 lakh crores. This is a huge jump. Usually when such a jump takes place, it will squeeze out other borrowers. Government starts borrowing so much money, then the other borrowers, the companies, the corporates, small borrowers, they can't get access to credit. It always becomes a problem. If government is borrowing more, then it hurts the private sector and the small borrowers. So where our Reserve Bank of India steps in, it has to ensure that this extra borrowing is provided for easily. Because if it is not easily available, then interest rates will go higher, because more people will be competing for the same money. So RBI comes out with its own operations. So we have open market operations, we have the TLTRO, we have purchase of bonds by RBI, the operation twist. So there are many tools by which they ensure that while government borrows more money from the market, it does not lead to increase in interest rates.
Within the overall framework of the monetary policy, these are specific measures to probably target weak sectors. Is that correct?
That is correct. Usually when banks borrow, so Reserve Bank of India says that, okay, you can borrow. It tells banks that you can borrow money from us and lend to certain sectors, no priority sector or the government bonds. But there is a limit on how much borrowing they allow for the banks for this purpose. Now, because banks were putting all the money in government bonds, banks were not lending to private companies. So Reserve Bank of India came out with a mechanism called TLTRO, targeted long-term repo operations. So they are saying that, okay, banks which are lending to the companies, either through non-convertible debentures or through corporate bonds or commercial papers. Now, for lending to companies, you can borrow from a separate window. So TLTRO is a separate window from the normal repo operations, saying that, okay, these funds should be used only to lend to private companies and not buy government bonds. That is how they have incentivized banks to lend to private companies separately from the government bonds. So that is how they have done, and I think, again, very intelligent thing to do.
Crowding out of the corporate bond raising, etc., in terms of lack of demand for corporate bonds, had a direct impact in terms of one of the mutual fund houses had some issues with their debt funds and they had to suspend the repurchase of those or redemption of those funds. That was an example, is that correct?
That is true. Usually, if government is a borrower from the open market, then small companies or corporate sector, it gets crowded out because banks will prefer to lend to government rather than to private companies because of credit issues. So, Reserve Bank of India wants to ensure that enough credit is available to the private sector. Now, for doing that, they have come out with an operation called TLTRO, Targeted Long-Term Repo Operations. Basically, banks which borrow money from RBI through the TLTRO window, you can use that money exclusively for corporates only. They cannot raise money from this window and then invest in government bonds. So RBI is ensured that banks have enough liquidity for lending to the private sector. If banks, of course, can borrow in the repo window and then use it for buying government securities, there is no problem. So I think this targeted lending to corporate sector has done very well for the corporate sector and for the private consumption.
So another interesting question is regarding the housing finance. I believe that the RBI is looking for ways to stimulate the realty market, and they've managed to do that by changing the risk weightings for the loans. Is that something that's going to work?
They have incentivized borrowers as well as lenders. When you take a loan, let's say somebody takes a home loan for 1 crore rupees. Now, bank can give a loan of 1 crore only if it already has 35 lakhs or 35% of its own funds, which is called the capital of the bank. Now, this rates used to go higher as the loan amount would go higher, and it was linked to many other factors. Now, Reserve Bank has said that this weight, the 35% or 50% was in many cases, has been reduced. Now, this will mean that banks will have more money to lend to borrowers, first thing. Secondly, when you have lower risk weight, then the interest rate also goes down because banks are able to turn around their capital faster. So, by reducing rates, they have increased the profitability of banks on the housing loans. At the same time, they have ensured that the borrowers who want home loans, they get more credit. They get it more easily and they get higher amount of credit for their loans.
So, Puneetji, looking at the numbers, the second quarter of the GDP growth was quite poor, 23.9% reduction due to, of course, the lockdown, the full lockdown that happened. Overall now, Mr. Das, the RBI governor, is saying that there will be overall 9.5% reduction for this year, but that means the green shoots are showing. Would you like to talk about this now?
I think the worst in terms of GDP decline is behind us. So the April-June quarter, the first quarter of this current calendar year or current financial year, we had a very sharp fall of 24%. But going forward, I think we will see that the economy will pick up. And overall, for the year, for the complete year, they're talking about GDP decline of about 10%. I think that is fair given the fact that it's a huge economy. I mean, India is not a small country where economy picks up at the top of a hat. Clearly, we are going to turn around. And not only this, I think we're going to rebound very strongly in the next financial year. But yes, in the current year, we will see decline in GDP to some extent. But we see green shoots, like you said. We've already seen a pretty big jump in electricity consumption. Electricity consumption in first week of October has gone up by 13% year on year. That is, over the last year, we are already growing. If you ask me honestly, I think we will do better than 9.5%. Probably will decline less. But definitely, I think the economy is on the mend. We are going to do much better in the coming months due to festivities and due to busy season. Agricultural sector has done extremely well. Rural sector has done very well, showing no decline in growth. I think all these things really help us to expect that economy will do much better in months to come.
Puneetji, thank you very much.
Thank you so much.
You were listening to a discussion on RBI monetary policy and impact on economic growth. The participants were Puneet Jain, economic analyst, and Arya Madan Mohan, journalist. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app, News on AIR. This program is also available on our website, newsonair.com. You may email your opinion about this program at airnsdtalks@gmail.com.